Hi, welcome to Trading with TK, teaching you to turn ideas into money. And this is our weekend wrap-up. This is where I'm going to try and answer some questions that were sent in to me by some of our readers. And I can't answer everyone's question, but I picked out some questions that seem to have a common theme of interest. So let's get started, and hopefully I can be of help to you doing this. First letter comes in from John, and John says, love your blog. Thanks, John. I understand the importance of double bottoms, but my question is, why is a head and shoulders pattern so important, or so often as you have been showing lately, a reverse head and shoulders? Okay, good question, but the answer is very simple for me. Head and shoulders patterns don't always show up every day. They're not a common occurrence, but when they do show up, they're reliable. They play out the way they're supposed to play out. They're very reliable. And of course I like reliable patterns. So, I don't want a pattern that's only going to work 50% of the time. It's not good enough. I need a pattern that works 80, 90, or 100% of the time. And that's why I like these head and shoulders patterns. They're very reliable. I can't figure out exactly why everybody's buying or selling them, but when you string these days together, these patterns get formed, and it's a cumulative thinking process. Everyone gets a vote who's buying and selling, and these pictures gets formed, and it looks like a head and shoulders pattern or a reverse head and shoulders pattern. But they're mostly reliable. That's why I like to use them. Okay, I hope that answers your question, John. My next question comes in from Josh. Josh has two questions. Josh says, how do I spend my day during the trading hours? And I hear you refer to if they give them back, or if they take them up, or if they knock them down, and he wants to know what that refers to. Okay. I spend my day monitoring the market all day long. I have a watch list of at least a couple hundred stocks in there. I'm constantly going through them. When I finish, I start over again. And by watching these stocks all day long, I start to get a feel. I also watch all the major indexes. I watch the Dow, the transports, the S&P 500, the NASDAQ, the QQQs, all day long. And then I have some bellwether stocks that I like to watch, like Apple and Citicorp. This is where the big money boys are, and they give you a real good picture, a feel for what direction the market's headed in. And for instance, I got positive on the market about a month ago from watching Apple. And we saw Apple putting in a nice little bottom, a rounded bottom, right where it should have, in a big support area, and it looked to me like it was starting to turn up. Matter of fact, we recommended it a month ago at 125. We sold it at 144. But even the day I saw it, the day I put it on my video, I even said in the video, I think I see this thing going back to 200, and this is when it was at 125. So this is where I get my ideas from, and after I watch all these stocks and these indexes and these bellwether stocks, somehow or another my brain just seems to calculate all this stuff, and the answer pops out in me somehow or another. It's all almost automatic. I can't tell you exactly what's going on up there, but it's just taking in all this information all day long, and then the answer comes out, or hopefully the right answer comes out. But so that's how I spend my trading day. The other question is about the days. Okay, the days is a Wall Street slang word that represents the forces that are pushing the market. All Wall Street traders talk about their trade of the day, and they'll say, yeah, I bought the stock at 25, and then they took it up to 27, and I got out. And then they knocked it right back down to 25 again. Now, we never know who the theys really are. I've never met a they. I don't think I'm one of those theys. And I don't know anybody else who ever met a they. So, anyway, that's a slang word, and it means the forces of the market. That's what the word they means. Okay, I hope that answers your question. And the final question that comes in is probably one that's going to confuse you the most. I hope you walk away with more information after I finish this than I hope I don't confuse you with this. But Garen writes in, he wants to know, he says, I was wondering if you could explain how a New York Stock Exchange specialist figures out where to price the stock before the opening. Good question. Okay, there is a process, okay, and there are guidelines set by the New York Stock Exchange. The specialist can't just do whatever he wants, okay, and I'm going to give you these guidelines. They change from time to time, but I believe these are the latest, okay. Stocks $10 and under cannot be opened up more than $1 from, or it can't even be opened $1. It has to be under $1 from the last sale. and most specials are not going to open it like 99 cents. They're never going to open it that close to what they're allowed to, because then the market surveillance comes down on them. So they'll leave a little leadway in there. They're not going to take that kind of risk to be questioned on it. Okay, stocks from 10 to 100. The rule is the lesser of either 10% or $3 from the last sale. And stocks over 100 are the guidelines are $5 from the last sale. Okay, so those are the parameters. Now, under certain circumstances, let's take a normal day. If you got a $15 stock, you can open it. You can open it up $1 if you want, but it depends on the specialist position. Let's say he comes in long 10,000 shares. He's got a lot of buyers. He doesn't know why. There's really no news out. Just a whole bunch of buyers that morning. They all want to buy in the opening. So he'll look at his clerk and he'll say, if I open this stock up 60 cents, what would I be selling? And the clerk will say, you're not selling anything. There's stock left over for sale. Okay, that's not the right price. How about up $0.50? You only be selling 2,000 shares. Well, how about 45 cents? Oh yeah, you could sell about 9,000 shares. So that's what the specialist is going to do. That's the price. He's within his guidelines. He gets out of his 9,500 shares that he's long, but he then has to make an aftermarket. He has to support this stock. Now, by committing capital to the market doesn't necessarily mean selling stock on the opening if there are buyers. What it can also mean is that you don't have to participate on the opening, but you need to commit capital right after that by supporting the stock if it starts to come in for sale, and more than you normally would under normal conditions. And that's the price that you pay for having this franchise in this stock. And if you fall down on it and the exchange doesn't think that you do a good job, you're going to lose that stock. You're going to give it to somebody else. So that's the price you pay if you don't abide by these rules and regulations. Okay, let's take a little bit more complicated situation. Big news comes out, major news, buyers all over, hundreds of thousands of shares to buy, and let's say the last sale is 20. And you're looking, and all of a sudden there's so much to buy. There's no way you're going to be able to open this up within the parameters that are already set forth. So there's huge disparity here. So you've got to go get 2 floor officials and a governor, and they'll come in. They'll probably put on the tape dissemination of news. So when you see dissemination of news on the tape about a stock, that basically means order imbalance. Now, there's a dance that goes on now, okay? All the floor brokers who have an interest, who have customers, are coming over to the specialist, and they want to know exactly how many shares have you got to buy, and about whereabouts you think you're going to open this thing. So this information starts flowing back and forth. This is before the opening on the floor. This is why these institutions still keep these floor brokers around, because they're a great source of information interacting with the specialist and finding out how big the opening is going to be. So then the process after that is, once they see how many shares they have to buy, what they'll do is they'll put up a very wide indication. It's called telescoping. And what they're doing is they'll say, okay, the last sale is 20. Our initial quote's going to be 21.25. And then they see what that brings in. So orders start changing immediately. Oh, I don't want to buy that much if it's going to open at 25. The guy who's a seller at 26 says, no, I want to get on a sale. I'm going to lower my order. So the picture starts changing. So after a while, after a couple of these, you start to see, and it takes a little while. This is why it takes a little time to open these stocks. The quote starts getting a little bit smaller and a little bit smaller until finally they get it down to an area that makes sense. And usually it's somewhere in between that initial 21.25, probably going to be somewhere around 23 usually, but that's the process they go through, and they need official okay from a floor official and the governor. So by the way, a tool that now is offered, you can see the specialist book. You can subscribe to what they call the New York Open Book, and I think it costs about $60. Your broker offers it to you. I think it's money well spent. You can see the specialist book. What a great opportunity. You can see all the bids and all his offers he's got on all his books for $60 a month. I think it's a great tool. I have it. Anyway, I hope that answers your question, and until Monday, this is TK signing off.